Altcoins are flat. Bitcoin hit 70k but fell back to 60k. Is this now resistance? Stablecoin market cap hit 300 billion, led by two giants. Is this a flash in the pan or a new start? March 3rd, BTV's Michael here with your 24-hour data summary. Bitcoin is between 68k and 69k, knocking on 70k again, but still just short. This time, it's not an issue on the blockchain, but rather the tension in the Middle East that's heating up. With the situation in the Strait of Hormuz becoming tense, as everyone knows, about 20% of the world's crude oil transport could be affected. Oil prices have already surged above $77, so inflation expectations are rising, and the Federal Reserve's room to cut interest rates has been squeezed even further. As a result, Bitcoin has become a high beta asset, rising and falling along with other risk assets. Looking at the blockchain again, about $2.06 billion in stablecoins flowed in over the past week, which isn't particularly strong. The Coinbase Premium Index is currently negative 0.027, indicating that US spot buying has basically not returned yet. ETF inflows are around $778 million, which seems more like defensive long-term holders. At present, there hasn't been large-scale selling, and the current ratio of 0.53 hasn't reached a high distribution zone either. $64,000 is the nearest support level. $60,000 is the defensive line for options, but the real switch depends on inflation and geopolitical factors. Now let's take a look at altcoins. Currently, about 38% of altcoins are trading at or near their historical lows. In other words, 38% of altcoins have either fallen below their historical lows or are hovering around their lowest prices ever. In April 2025, this figure was 35%, and after the FTX collapse, it was 37.8%. So this is already a cycle-level indicator of a crypto winter. This situation usually occurs during a liquidity drain phase. Money first clings to Bitcoin or stablecoin assets off the exchange, so small and mid-cap coins are the first to take the hit. In this cycle, it's not just a single point of exposure, but rather a combination of shrinking trading volumes, slowing growth of stablecoins, institutions only buying mainstream coins, and deleveraging all happening at once. As a result, many projects have been pushed down to near the bottom of the cycle. So, looking at history, when the proportion that is close to historical lows surges, it often means that extreme sentiment is reaching its peak, and there will still be some volatility in the short term. However, from a risk-reward perspective, you should know that when pessimism reaches its limit, opportunities are also being foretold. Since last October, Bitcoin has fallen all the way from $126,000 to around $60,000. The Coinbase Premium Index has long stayed in negative territory, indicating that the basic market in the US is essentially absent and buying interest is very weak. At this stage, ETFs are still experiencing periodic outflows, so the $90,000 mark was directly lost. At the beginning of February, it dropped as low as $61,000. So where did the turnaround happen? In late February, US spot ETFs saw an inflow of $1.1 billion over 3 days. BlackRock alone saw an inflow of $625 million in a single day. Coinbase's Premium Index, which had been declining for 40 days, finally turned positive, reaching around 0.05, and the price rebounded to about $68,000. Currently, the funding rate is not high, and leverage hasn't piled up, which at least indicates that this price surge was driven by spot buying. Next, we need to keep an eye on two things. First, whether ETF money is actually coming in. Second, can the premium remain stable? Alright, please like this video and turn on the notification bell so you can immediately stay updated on the key news happening in the crypto world 24/7. As you all know, the war between the US and Iran is still escalating. The day the missiles were launched happened to be a weekend when the traditional financial markets were closed. Therefore, cryptocurrencies became the only major asset pool where trades could be executed and amplified in real time, so the concentration of liquidity magnified the overall price volatility. Right after the missiles were launched, Bitcoin surged to around $70,000, correct? But after reaching $70,000, there was profit taking, and many people started selling Bitcoin at that level, which then pushed the price back down to around $68,000. So this surge was more a reflection of sentiment-driven movement and liquidity resonance, rather than a structural reversal.
Blockchain analytics firm Elliptic reported that within minutes after the airstrike, outflows from Iran's largest exchange, NovaTex, surged by more than 700%, reaching nearly $3 million in a single hour, according to Elliptic's co-founder. Tom Robinson pointed out that this reflects how some capital is being transferred through crypto channels to evade oversight by the banking system.
For next year, but I do think it is ISM sensitive and interest rate sensitive and dovish Fed sensitive, so it's also.
At the Wall Street level, Yang Fan Aike from 1X said that the market is currently bottoming out and believes we are in a cycle recovery phase. Jim Morgantree CEO Jamie Dimon, however, warned that if the conflict continues, rising energy prices could once again drive up inflation.
All right, this round of war at least shows three things. First, let's look at the function. When the shells were fired, Bitcoin shot up to 70,000. If there wasn't real buying, the price definitely wouldn't have gone up. So there was indeed real capital treating Bitcoin as a risk hedging tool, as a safe haven asset. Second, it depends on the macro environment. If the conflict is about to cool down, everyone goes back to focusing on whether interest rates will be cut or not. The issue of whether money will be loose or tight comes up again. But if the war breaks out and oil prices soar, then inflation will definitely rise, and the probability of the Federal Reserve cutting interest rates will be pushed back. So it's only a matter of time before Bitcoin pulls back to $60,000 or even drops below 60,000. Third, let's look at the chart. Bitcoin has tried several times to break through above $70,000 but hasn't succeeded. Although the lows have been getting higher, it's still moving sideways, and trading volume has been consistently decreasing. So in the end, war is just a shadow, while the real direction of the price depends on the liquidity tap. Stablecoin growth is a key indicator for a crypto market turning point. Latest data shows the stablecoin market cap has topped $300 billion. This isn't just crypto hype, as not all these funds are in the crypto space. Traditional firms like Metabank are now integrating stablecoins into their systems to link global payment and settlement networks. Stablecoins are growing and now extend the US dollar on-chain. 300 billion is huge, but where is it and how fast does it move? Is it traded or idle? Scale is just the surface. Structure matters more, and that's the truth we need to uncover.
Structurally, the stablecoin market is highly concentrated, with USDT accounting for about 197 billion US dollars, about 73 billion US dollars, making up a combined total of approximately 89%. However, the second tier, such as USDS, PYUSD, RLUSD, and others, is growing rapidly. Ethereum remains the main blockchain. In terms of structure, exchanges hold about 80 billion US dollars, making them the largest source of demand. The daily transaction volume reaches 1.03 trillion US dollars, which is significantly higher than the total supply, indicating a high liquidity turnover rate.
And when it comes to real-world assets, the vast majority are fiat currencies, and most of those are US dollars. So essentially, what we're doing with USDC is taking the dollar and putting it into a native internet form so it can be sent as easily as an email or a text message. In essence, it's about digitizing or tokenizing the dollar.
The increase in stablecoins, or rather the growing issuance of on-chain stablecoins, only indicates that blockchain as an infrastructure will increasingly enter the track of traditional financial infrastructure. So how much of this liquidity will actually flow into the crypto space? In the future, if AI experiences explosive growth, do you think that transactions between AI agents will choose stablecoins as the medium of exchange? Join the discussion in the comments. Are the popular AI assistants just money pits or privacy leaks? Are they really making things easier or just causing more trouble? As digital finance in Asia experiences both boom and bust, how should regulation keep pace with technological innovation? In crypto today, no AI assistant means you're out. As Brother Sun says, those born before the 90s are obsolete. From Clubbard's rebrand to Open Cloud, the cell is 24/7 monitoring of every detail for you. It can handle everything for you, sending emails, checking your calendar, browsing group messages, and replying. So when this digital avatar starts consuming your tokens, asking for your money, and making all sorts of demands, do you think it's actually making your life easier or just adding more trouble? Take our own AI, for example. Maintaining it is pretty cheap, but just think about it. Buying Glassnode alone costs $9,000 a year, and getting a data package from CryptoQuant for a year is about $8,000. Just for its APIs and all this data, we're spending close to $100,000. Do you think it's worth it or not?
It's like Linux and OpenClub, just wonderful pieces of technology. They are not products. And it's not just about the deployment. That's just an opinion. Yes, deployment is a pain in the ass, but you see a lot of those products that claim you can deploy OpenCloud with one click. That still does not make it a product.
OpenClock polls tasks half-hourly, emails, calendars, and Telegram all incur API costs. For small, lengthy tasks needing multiple model interactions, your monthly bill can exceed $150, more than a Cloud Max subscription. So-called long-term memory has limited stability, and will still forget things over extended use. More importantly, there are security risks. Security agencies have disclosed numerous vulnerabilities, and unprotected instances can be scanned on the public internet. The exposure of API keys and chat records has shifted the issue from efficiency to usability and security.
Products that offer one-click deployment of open cloud still don't make it a true product. Even if you can deploy to different clouds with one click, it's still not an opinionated product that works out of the box for you. You still have to set it up. I can't tell you how many people have told me, I still have to set up open cloud. It feels like it's cool.
Now everyone has gotten smarter. They use the cloud to define their identity, use Midjourney to define their preferences, and then try to give them as many free plugins as possible. This way, the features might be a bit limited and the speed a bit slower, but it saves a lot of money. I believe our AI can help us earn back all the money spent on data and APIs, because at least so far, when it executes our contract trades, its win rate is 100%. If you do not believe it, you can go to the contract copy trading section on HKEX or Binance and try out our AI to see just how high its win rate really is. Asia's digital finance scene is currently quite interesting. On one hand, it balances innovation with compliance and regulatory loopholes, while navigating certain countries' strict regulations against financial disruption. So blockchain and digital assets are no longer niche topics. You can see their presence in cross-border trade, financing, and investment. However, as the technology needs to be upgraded, regulatory frameworks must also keep pace. This is why Korea, Hong Kong, and Shanghai form a striking contrast with each other.
First, let's look at the cooperation agreement signed between Hong Kong and Shanghai, which plans to promote the construction of a cross-border blockchain platform under the Assemble framework. The goal is to integrate trade data, electronic bills of lading, and financial applications to improve customs clearance and financing efficiency. The project will rely on Hong Kong's existing key pilot initiatives for advancement. At the same time, Hong Kong intends to offer tax incentives on certain overseas digital assets to attract capital and institutional participation.
Look, I think the main benefits ultimately relate to increasing the level of confidence that end consumers have in the authenticity of the product itself. There is currently a significant amount of concern about food fraud. In just the past 24 hours, we've seen a surge in worries about food fraud, especially regarding the adulteration of honey.
In South Korea, the National Tax Service accidentally leaked the complete mnemonic phrase of a confiscated hardware wallet in a press release about cracking down on tax evasion. Approximately 4 million PRTG tokens, valued at about 6 billion Korean won, were transferred out within a few hours. After the incident escalated, Deputy Prime Minister and Minister of Economy and Finance Chu Kyung-ho stated that the Financial Services Commission and the Financial Supervisory Service would conduct a joint cross-departmental inspection to strengthen the procedures for the seizure and management of digital assets.
So when you put all these news stories together, the answer is actually pretty sobering. In today's digital finance world, it's no longer about whether you allow it or not. Blockchain is no longer just about that. What people call black technology is actually an infrastructure that operates every day, has been repeatedly tested, and can withstand scrutiny and challenges. Whether you ban it or allow it, it's already here. And this change is bottom up, not something you can suppress or prohibit with a document. Going with the trend can help you find opportunities for development. Going against the trend, have you ever seen a centralized institution that could stop technological progress, like a mantis trying to block a chariot? All right, let's look at the news brief.
Or Ocean has mined the first VIP 110 support block, aiming to restrict on-chain junk data. Opponents directly inscribed a large image on-chain to clap back at Bitcoin. What was once a canvas has now become a battleground. This fight is endless. Wei Shen posted a blog saying he wants to poison and eliminate the loopholes that allow a few nodes to monopolize block production. And by the way, to cure the toxicity, specifically those parasites that deliberately add regular user transactions. After years of calling for decentralization, this time they're really taking action. Bitcoin and Ethereum are lying low during the bear market. Meanwhile, gold keeps rising, and now they've even launched weekend US stock betting. While others are searching for the bottom, they're happily opening a shop. Nasdaq is asking the SEC to launch binary bets on the Nasdaq 100's ups and downs, which is exactly the same as Polymarket's gameplay. Wall Street used to criticize the obsession with gambling for years, but now they're secretly copying the homework themselves. SoftBank's subsidiary Pepe holds a 40% stake in Binance Japan, and now they're planning to IPO on Nasdaq. With a target of raising $1.1 billion, are they really fearless to ring the bell during a bear market, or are they just eager to cash out?
All right, in the past couple of days, AI has indeed brought a lot of logical innovations to our existing values and the rapidly changing workplace environment. You have to understand that the most dangerous thing right now isn't how fierce your competition is, but that you're still standing still while the entire industry is upgrading, technology is advancing, and job roles are being restructured. What was your advantage yesterday might become a barrier today. Instead of worrying about how fast others are moving, you should ask yourself whether you are continuously upgrading. The real gap is never created by one or two bursts of effort, but by long-term steady accumulation. You have to understand, the workplace never rewards emotions, it only rewards ability. When others are complaining that the environment is unfair to you, ask yourself again, have your skills improved? So in the workplace, don't see yourself as just a worker, treat yourself as a project. Don't just calculate your salary returns, consider the returns from your personal growth. Ultimately, what determines your position isn't the title the company gives you, but how many real problems you can solve. If you understand this, give us a like. That's all for this episode. All of our membership benefits are included here. We hope you'll join as a member, and let's strive together. Change gradually, and you'll see wealth along the way.